And for more analysis, Chad Slater, the Joint Chief Investment Officer at Morphic Asset Management and a funds manager. He joins me live from our Sydney CBD studio. Chad, thanks very much for joining us.
Cheers, thanks, Helen.
Now, this Fed balance sheet day, everybody is looking towards it. But I mean, this whole story began, what, in August 2008?
Yes, August.
Yeah, and will we see a plan, the roadmap, 4 a.m. our time tomorrow?
Yes, yeah. You say August 2008, Helen. It's been a long journey if you think where the world's come from. When Bernanke back then started their first QE steps, when they had less than $1 trillion on their balance sheet now to ending up there at $4.5 trillion. It's been a remarkable journey, and I think tomorrow sort of ends one leg of this journey. You asked about what the roadmap is. I think they've been pretty clear about what their roadmap is. One of their addendums released said that they're going to start at $10 billion a month. And what I should be clear to your viewers as well is this isn't so much reducing it by going out there and selling them. This is letting the proceeds that they receive not be reinvested. And that's going to build up to about 50 billion.
So they're not buying more bonds?
Yeah, no, it's one of the things that obviously when you own a bond, it has a maturity date, and at the end of your maturity you get your money back. And the Fed has been reinvesting that. So all they're saying basically is they're going to stop reinvesting a portion of those. So they haven't been expanding it, but they haven't been even shrinking it. So that's going to go up to 50 billion a month sometime next year.
Now, even at that rate, 50 billion a month, I mean, I can't do the maths, but anyway, with $4 trillion or $4.5 trillion, it is going to take a very long time to shrink this, isn't it?
Yeah, assuming you were to go back to zero, it's the better part of 8 years to get there.
And is that how long they will take? Do they want to take it that slowly and cautiously?
Look, to give them credit, at the start they should take it cautiously. You don't really know how the mortgage-backed security market is going to react, and that is actually where they'll be doing their first changes. And they've also said that they actually want, and the piece here you put on before alluded to that, they want to keep their balance sheet larger than where it was in 2008. And they're guiding to somewhere around 2 to 3 trillion. So realistically, at the full run rate of 500 billion a year, it's maybe a 3-year task, but still nonetheless not a short task.
All right, so I guess a key question for the market is the unwinding is important, but perhaps not as important as when they had to do QE. But how will the market sort of take it?
Yeah, look, it seems, if we go back to 18 months ago, people were very nervous about, oh my God, the Fed's going to reduce its balance sheet, this will tighten liquidity. Now we've had a number of rate hikes and we haven't seen any major issues thus far. Rightly or wrongly, the market's pretty relaxed about this. In fact, before I came on here, we were scouring some of the morning notes to see what some of the other people had put out there ahead of this. And basically no one's worrying too much about the balance sheet. They're all worried about, is the Fed going to lower inflation forecasts and therefore maybe take a December rate hike out of play. So the market's very relaxed about the balance sheet, it seems.
All right, now can I bring you back home? There's been a huge amount of talk in recent weeks and months, both at a political level and in business circles, about energy policy, energy crisis. The ACCC chair spoke about it very sort of simply and bluntly, I thought, at the National Press Club today. What is your view as a global investor? What do you make of the government's attempted intervention and fairly strong-arm intervention with one company, AGL?
Yeah, it's a good way to put it, Helen, because whilst we are Australians sitting in Australia, we look at global stocks. And it is odd when you turn your attention back here to the local energy market, just how remarkably dysfunctional this place has become. We have some of the world's most abundant solar, i.e. a lot of sunlight. We have coal, we have gas, and we're meant to be a stable democracy with a properly regulated infrastructure. And I think at the moment, sadly, we're taking world's best practice for how not to run an infrastructure policy. It's just incredible. We've got to this position, and particularly under what was meant to be a business-leaning government by a former businessman himself. I'm flabbergasted sometimes watching this stuff.
Yeah, so just I guess that key thing is business want certainty. They want a policy, they want some sort of guidelines.
Yeah, it's the one thing you see all around the world, whether it be looking at South African businesses, European businesses. Businesses themselves have their views. They may want a coal price, they may want a carbon price, they may not. But at the end of the day, what they desperately crave is certainty. So if they know there is going to be no carbon price, therefore they make their plans around that. If there is going to be a carbon price, they make their plans around that. But swapping and changing, inability to make up their minds, that's really hard for a business to make a decision. And it gets even worse when you're in a long-dated decision-making business like energy infrastructure. What you end up with is this ridiculous result where nothing happens. So it's the worst of all worlds here at the moment as an outsider looking in.
All right, Chad Slater, Co-Chief Investment Officer at Morphic Asset Management. Thanks for joining me.
Cheers. Thanks, Helen.